All right, today I'm talking about some things to consider before you start investing. So, this is a very serious subject, and this is why you need to come in with investing with some kind of plan of action. If you don't come in with a plan of action, you're going to get burned. The first thing to consider is what type of investor are you? Are you an active investor or are you a passive investor? This is going to make a big difference of how you go about investing. And keep in mind that there's no one right answer. Some people may be more active, some people more passive, or some people may have multiple pools of money to where one pool of money they are very active with, another pool of money they have very passive with. So, for example, I have an active portfolio and I have a very passive portfolio. So, I have two buckets of money. But anywho, an active investor is going to be someone who's maybe interested in the day to day or week to week changes of their investments. So they'll be looking at specific stocks, so specific companies, Apple, Ford, Tesla, GM, wherever it may be. You can look at individual companies, buying and sell them fairly actively. So maybe weekly, daily. So this means you're very involved with what's going on with the company. So the idea is because you're so involved with what's going on in the company, what's happening to the stock, maybe some trends, that you're going to pick the right company to sell and buy at the right time. So you could eventually beat the average investor, beat the stock market return, beat the S&P 500. But with this, because you are buying and selling stocks much, if you're not having a tax efficient portfolio, you could be potentially paying a lot higher taxes. So that's something to consider, and it is takes a lot of more time than the average person. So some people may not have time to do it, or say, "Hey, I have time to do all this research, but I'd rather take a back seat and enjoy some other things in life instead." So that's one way of thinking. The other is passive. So with passive is, hey, I'm not going to pick a specific stock. Maybe I'll let an investment person do it for me. Maybe I will pick a S&P 500 portfolio and have it do all the investing for me, or maybe I'll take some kind of time horizon funds where it says, hey, retirement of 2065. So the people who are investing in that fund should be investing with the idea of, hey, it should be good for retirement if you're retiring 2065. The good thing with that is, one, you don't spend near as much time on research. Two, you pay less taxes because of that, because you have something called long-term capital gains or qualified dividends. So you fit in one of those categories which you get taxed at a lower rate than you would otherwise have been. So if you don't know, if you have something that's a short-term capital gain within bought and sold within a year, or you hold a stock that pays a dividend and you had to held that stock less than a year, you pay at wherever your current tax bracket is. Versus if you hold it for longer than a year, or you hold a stock longer than a year and get paid dividend to it, it's qualified or long-term capital gain. So therefore, it's taxed at a lower tax bracket. You pay less. So, uh, but with that, you are less likely to beat the S&P 500. You're less likely to beat the average investor. You're more likely to get the average return. But hey, that's a trade-off. What do I spend more time in? Researching and buying these investments, or I want to spend time doing some other things as well. And some people say, hey, yeah, I can start my own business, make more money that way. So, or spend time with family. It's whatever you value. So, this is a very decision that everyone has to make on their own. The next thing to consider is, what is your risk tolerance? Are you someone who says, hey, I have a long term to invest. I'm not worried about withdrawing these funds soon. So, you know what? I'm going to YOLO it. I'm going to try off some risky stuff, but because it has a potential to have a high return. So, some more aggressive stuff. Or am I going to be someone say, hey, you know what? I am going to say, hey, I don't want to be so risky. I want to have good chance of making money, but I'm willing to forego some of the big rise and potential of some of these stocks in exchange of getting an average return. I'm taking the average risk to get an average return, and I'm okay with that. And some people say, you know what, I may not. I'm risk averse. I don't like taking risk. So you know what, I'm gonna play it safe, and I'll take the less returns for more guaranteed bet. So, for example, U.S. bonds. So U.S. bonds typically historically have always been paid. So this is considered pretty much a guaranteed investment, even though it's not truly guaranteed, but it essentially is. But because of that, you don't get much of a return on it, maybe a few percent. Lately, it's been going pretty up because of inflation, but I digress. Another thing that could have played an effect on this is your time horizon. If you're further from retirement, you may be able to take the chance of, you know what, I could lose my money early because I'll still have time to make up those losses in the long term. Versus if you're near retirement, you want to be a little more conservative because at that time, hey, I'm about to retire. Last thing I want to do is take a big risk of my money and lose all my money. I don't say, hey, I'll take a little bit of risk, take a little money, so I'll pretty much have my money is safe where it is. And if you're kind of maybe midway through your life, it's going to be somewhere between. So it's kind of a sliding scale. So that'll kind of help you figure out where you want to be when it comes to how aggressive or conservative you want to be. Another thing to consider is what type of investment account to use. Do you have an IRA, individual retirement account that you want to open up yourself? Is it a 401k? Are you going to invest through your employer? Is your employer offering a 401k account? So if you do, you could invest in that kind of account. Once you hit that match, it may not be as beneficial to do it so, or you can do your own personal brokerage account. So it kind of depends on how you want to do this. All these have different tax implications of these. These are something you want to look for. And I'm going to do another video to go over these accounts in a lot more depth because there's tons of more types of accounts. But again, I'm going to try to keep it short and sweet for today. The last thing I don't have listed on here is have your finances in order. The last thing you want to do is invest in the stock market or invest in something and have an emergency and not have money to cover that emergency expense, to then have to pull your money out the stock market at a possible loss. So make sure you have finances in order before you start investing, because otherwise you could hurt yourself in a number of ways. So if you want to invest, make sure you have the emergency fund saved up or you have some kind of stable income, etc. Be sure to like and subscribe and tell me what you want to know next.